Welcome to the Real Estate Investment Podcast with Colin Murphy, a podcast for anyone who wants to learn more about building a rental property portfolio with strong cash flow and stable tenants. Here's your host, Colin Murphy.
Hey everybody, this is Colin Murphy and welcome to Torcana Real Estate Podcast 34. So Jared Garfield is my guest today and he's one of the top real estate investors and educators in the country. Jared and his teams have closed, renovated, and managed more than 3,000 properties in 5 different states. He also runs a successful real estate coaching platform, and he's trained more than 1,000 clients as they build real estate portfolios. Earlier in his career, Jared spent 2 years hosting the Rich Life Real Estate Show on various Fox affiliate radio stations, and he spent 3 years working with Robert Kiyosaki, training the Rich Dad, Poor Dad coaching staff. So aside from his multiple real estate businesses, Jared is a busy father of 5 children, and I'm delighted that he's able to set aside time from his schedule to join us on today's show. Hey Jared, how you doing? Welcome to the show.
I'm doing well, Colin. It's great to be with you today. Thanks for having me.
No, it's my pleasure. It's my pleasure. I've been looking forward to this for a while. So for the people that don't know about you, Jared, tell us a little bit about your story and how you got into real estate.
Colin, I started fairly young. I always really liked real estate ever since I was, this may sound nuts, but since I was about 9 or 10 years old, my grandfather would drive me around and show me deals. And my dad was working as a realtor while he was putting himself through college after spending time in the military. And so I would go to my grandfather's real estate office and listen to him talk and listen to him ask people about their homes. And every night he'd come home and I'd see him read the newspaper a lot, and looking for deals. Because back then in the 80s, people would circle and find investment deals through the want ads, through the classifieds. And he would take me flying in his airplane to go see land deals he had done. And
wow, he had an airplane?
Yeah, he did.
And whereabouts was this? Where were you living?
He was in Utah, and he had been the president of the Utah Board of Realtors. And he opened the first self-serve gas stations, and he had commercial part ownership in hotels. And he even sold the land for the Salt Palace where the Utah Jazz played at the time. And because he sold the land, he put his commission in and became a small minority owner in the Salt Palace where the Jazz played. So he had done really well in real estate. And so I kind of got really excited watching him and just hanging out with him. He was so much larger than life. He was so friendly and outgoing, and he knew everybody everywhere he went in town.
That is so cool that most grandfathers would say, here, come, I'll take you and get an ice cream. Your grandfather used to take you on a plane to go and look at real estate. That's very cool. I like that a lot.
It was the hard part for me, and this is what motivated me. I loved that. That made me interested in real estate because I realized it built people skills, that you got to be friends with people in the community. But the part that was tragic about his story was he owned a whole bunch of Class A apartments in a mining town called Price, Utah. And what happened was in the mid 80s, the government changed the regulation on smog and on coal plants. Mm-hmm. And so all the coal mining things that have been thriving with all these high-paying mining jobs, overnight they shut to like half capacity, and he had these brand new Class A apartments that were like 150 units, and he ended up having to shut them down, and he lost them all. He ended up going to his partners and saying, you know what, I'm going to take the hit no matter what, and why don't you sign over to me and I'll take the losses for everyone so you don't have to take the losses. So he did that. And in the process, not only did he lose his apartment complexes, but they had a Victorian mansion in a prominent part of town. They lost that. My grandmother ended up coming to live with my parents.
Wow.
And he died of a heart attack in 1987 at 62 years old because of the stress of losing it. And so I realized that when I got older and I got my real estate license and I started studying market cycles, I realized that real estate had the ability to create tremendous wealth. But I also realized that if you didn't watch government regulations, if you didn't understand demographic cycles, if you didn't understand market cycles, that you'd also get bit by real estate by getting in at the wrong time.
Yeah, because here's this obviously a very highly intelligent man, and that's terrible that it ended that way. But it sounds like you learned a lot from that experience and use that knowledge of his experience to make your own investment. So what kind of experience have you had since then, since you became a young adult and kind of ventured into real estate on your own?
So I started small in college. I don't know if you're supposed to do this, but I got a student loan and used that for a down payment because I had scholarships. And then I went and got a car title loan after listening to a Carlton Sheets coaching program. I got a title loan against a car that I owned free and clear, and bought a second foreclosure, flipped those, bought a third one that I made $42,000 on. And by that time I was so excited, I went down and withdrew myself from school about 10 hours from graduation and started a real estate brokerage. And we built up a decent portfolio of real estate stuff. And I coached and trained for Robert Kiyosaki with Rich Dad, Poor Dad for 3 years.
Oh,
Did
cool.
some bus tours with the guys from Flipping Vegas and Flip This House and Dean Graciosi. And then we proceeded to do about $120 million worth of turnkey properties in Atlanta, Kansas City, Huntsville, Birmingham, Montgomery, Alabama.
Wow, that's a lot. That's a lot.
Yeah, it kept us busy.
And so were you mostly in Atlanta at this time when you were working and flipping houses?
Yeah, up until about 5 years ago, I was primarily in Atlanta, and then we moved to Alabama. I started working the Alabama market about 5 years ago, and moved here a little over 2.5 years ago.
Okay, that's a pretty different market than Atlanta. What brought you down there?
Well, the billion-dollar hedge fund started coming to Atlanta. Atlanta had always been, since the 1980s, one of the top 3 markets that would go back and forth between Atlanta, Dallas, and Houston, trading back and forth for population growth and housing market growth. And so it really wasn't in need of a major correction. But when 2007 hit, Atlanta prices, you could buy 2007 homes that had been built in 2007 for $35,000 to $50,000.
Oh,
and
wow.
So I went over there. We started doing about 25 homes a month. And it was really just going gangbusters. I mean, in over a 6-year period, houses that we were in for 45 sold for 170,000 6 years later. And so it was just a really good ride. But what happened was all the Wall Street hedge funds came in with 10 billion, 50 billion, and they had so much money, they were buying up 50 houses, 100 houses, 500 homes a month. And so we sold a whole lot of our inventory to the billion-dollar Wall Street hedge funds, and I couldn't get deals there anymore. And so I realized that by going to secondary and tertiary markets like Huntsville and Birmingham and Montgomery, I didn't have the competition with the hedge funds. And they were also not as far along on the cycle. They actually started their downturn well after Atlanta did. And so the prices had not come up yet. And so you could still buy really cheaply.
It's funny how your story mirrors part of my own, because the same kind of thing happened to us, where we used to be getting incredible deals back in 2009, 10, 11, and 12 in places like, Orlando, Jacksonville, Charlotte, and then like low-hanging fruit, basically a lot of low-hanging fruit. But then the big hedge funds coming in, and the prices that we used to pay for these B-class neighborhoods shot up, and we were offered similar inventory at, same prices, but in D-class neighborhoods. And they're just hoovering up everything and paying too much for everything. And then a lot of the times they're trying to resell it at inflated prices. So we just got out of there, and we looked for secondary markets in Tampa, which have been tremendous for us over the last 5-6 years. And there's a lot to be said for avoiding the bright city lights and focusing on these nice, steady suburban markets that where you can get really good value for money, good cash flow, and where the big billion-dollar hedge funds just really aren't looking there. That they're focused on the glossy stuff. So that's been a lesson I've learned.
That really speaks a lot for your integrity, for you and David, because a lot of turnkey providers, they don't want to have to move to a different city. They don't want to have to reestablish new property management, new construction teams. And so they do exactly what you said. You see so many people that used to sell C+ or B houses, and then they move to D and F. And they rehab them really nicely, and they'll put granite on it, and they'll say, "Oh, this has all new wiring, all new plumbing." Well, of course it has all new wiring and new plumbing. It's a 1910 house that had knob and tube wiring and had didn't have circuit breakers and had fuse boxes. So of course it's all brand new, but that doesn't get rid of the fact that it's in a 40% poverty zip code with 5 times the national crime. And yet they'll do an A-class renovation and call it a B property, even though it might be demographically crime and income-wise in a D or F area. And then they sell that promising the same returns of what they were getting in the C plus and B inventory when the market hadn't, gone past its prime. So that's good integrity on your part.
Yeah, no, I saw it a lot, and people were over renovating properties and selling them for way more than they should have been, and kind of promising rental returns that just were not achievable in those neighborhoods because nobody could afford them. But yeah, that was a long time ago, and most people have wised up to that. But one of the things I like about you and your company, Jared, is that you're a numbers guy. You like looking at trends. You like your huge spreadsheets. You've sent some of them to me, and you're all about market cycles. So talk to us a little bit about market cycles, and particularly for our listeners, whereabouts in the cycle are we now? I mean, is this the time to buy? Is it the time to sell? Does it depend on where you are? I mean, talk to us a little bit about that.
Wow, that's a lot of stuff. That might take me a minute. I think first is just to outline the cycles and what they are. Expansion cycles would be kind of what Tampa is probably in right now. Huntsville's certainly in expansion. That means you're starting to really see a lot of reinvestment into the city. You're seeing, opportunity zones where people are investing a lot of money. You're seeing revitalization. You're seeing new jobs, new schools, new roads being developed. A lot of population may be moving there. Prices may start to really go up. So if you've bought, you can do really, really well. But during an expansion market, the only time you're going to really find great deals is doing what like you and David are, where you're sourcing off-market properties, because largely the stuff in the MLS has gotten too expensive, and you can't pay so much for it and still make a good investment. We find the same thing in our Huntsville market. So expansion is going to have a lot of job growth. That's where you're going to get a lot of appreciation. When it moves to equilibrium, that means that now all of a sudden homes are sitting on the market a little longer. Days on market are getting longer. Instead of being a seller's market where the sellers were selling above list price with no concessions, you might start to see a little bit of concession. Days on market is a little bit longer. Commercial shopping centers might start to have tenants that there's so many new shopping centers been built that some of the vacancies don't fill. Brand new apartments, start offering free color television, flat screen TVs if you move in with a 2-year lease or a 1-year lease, because they can't fill the apartments fast enough because maybe they overbuilt. You start to see home builders doing sales and reducing prices. Then from equilibrium, where the demands, the supply is starting to be slightly over the demand, you move to decline. A lot of times decline can be because a major employer in the area shut down. There could be economic obsolescence where jobs have moved to a different city. It could be a national thing like we saw in 2007. But during decline, if the stock market crashes and major employers start laying people off and there starts to be foreclosures, you're going to have a lot more inventory, and people start to question, well, when are things going to bottom out? Schools might even start laying off teachers as segments of population move to other cities, and so they even have to lay off teachers because there's not as many students. And then after decline, when the prices are dropping, you have absorption. When you're at absorption, you're kind of towards the end of the cycle, and that's when you really want to buy, because there's been tons of foreclosure activity and tons of foreclosure inventory, very much a buyer's market during decline. In absorption, it starts to be absorbed. And now we're starting to see that as the inventory gets absorbed, prices start to go, and we start to see jobs come back in. People have more hope. Companies start hiring again. And those are the basics of the economic cycles.
Okay. Makes a lot of sense. So expansion, equilibrium, decline, absorption. So, are different parts of the country in different market cycles? Because I know back like 10 years ago when there was the Great Recession, it seemed like the whole country kind of moved in the same direction at once. But I suspect that it's not normally like that, where you have different markets or in different parts of the cycles. Would you agree?
Yeah, you're exactly right. Now, there were a few exceptions during the Great Recession. So like, for instance, Pittsburgh had really been pummeled in the 80s when the steel industry really shut down, and Pittsburgh was a steel city. It was built on steel. That's why it's the Pittsburgh Steelers. So they actually had spent all of the 90s trying to attract tech growth. So while everybody else was crashing, Pittsburgh was actually doing pretty well during the Great Recession. There were a few oil cities like Houston, some of the Dakotas, Oklahoma City. There were some in those towns that were really pretty resilient and didn't take much drop during the recession because of oil. But you're right. Most of the country took it at one time. It was a bloodbath. But now what we're starting to see is it be different in different cycles. So for instance, where a lot of markets have surpassed where they were at the 2007 peak in March of 2007, most cities have surpassed where they were by 20 or 30% above the last bubble. What we see is there's some markets like Huntsville and Montgomery that are just barely recovered. There's a few markets in the country that still have not recovered where they were at the last peak in 2007, 11 years ago. But it is happening at different times. Like we're starting to see Seattle correct a little bit right now. It's starting to drop in prices and days on market are being longer. So we are starting to see, while we have expansion in some places, we are starting to see equilibrium and even a little bit of decline in other markets right now.
Okay. So yeah, that information could be useful, right? So what can you give us an example of a market that's gone way higher than their 2007 peak, and give us an example of a market where you think there might be good value?
Yeah, you and I both probably sell to a lot of properties to Californians. So let's take one market in California as an example of a peak market. And I've actually got a 19-page report that tells you some of the best cash flow markets and also covers some of the markets to be careful of. And we feel like Tampa is absolutely one of the best markets in all of Florida and one of the strongest in the country. But you can go to jaredgarfield.com/report, and there's some good study stuff on that. But for California, I think one of the things is San Jose. San Jose is a market that really exemplifies a bubble market right now.
Okay, so what can you tell us about San Jose?
So San Jose, if you had gotten into San Jose, that in March of 2007, the peak price was $720,000. When it crashed by August of 2009, it had fallen from 720 to 566. Right. So that was a very significant fall. But by 2018, it had gone up to 1,400,000. So you saw nearly a double. It had gone up 95% above the last bubble. So we had a bubble that had to correct because the median income couldn't afford a $720,000 home. And just to let you know what that is, and that's what sometimes that helps with forecasting which markets are going to correct. If the incomes don't keep up, even in a place like San Jose, where you might have two people, one person working at Apple and another person working at Amazon, and they're pulling in, $250,000 or $300,000 a year. Even if they're making $300,000 or $400,000 a year, $1.4 million for a median home cost is very expensive.
That's nuts. I mean, it must take a very long time to sell houses in San Jose if they're that expensive.
Yeah, I mean, the median income is only $90,000. The funny thing is, I don't know if it takes a long time because the people who live there, if they want to move up, they're rolling the equity from their other house that skyrocketed, because if they bought it at the downturn for $560 and today it's worth $1.4 million, they don't have a problem being able to sell and move up. But if you're coming from out of state, you can forget it. Because the median income is only $90,000. So I mean, even with that, somebody making $90,000, which is the median income, they can't afford a $1.4 million home unless they lived there in advance and they were able to roll the equity up.
No, and it would be very dangerous for them to buy one, even if a bank was foolish enough to give a loan to somebody who was earning $90,000 a year for a home that's worth more than $1 million. We saw a lot of that silliness during the last crash, and I don't think we're seeing it now. But just the fact that prices have gotten so out of sync with salaries would make me worried. If I was, number one, if you wanted to buy in that market, you're kind of stuck renting. But number two, if you're fortunate enough to maybe own a couple of properties or inherit a couple of properties in a market like San Jose, those are the kinds of people that are, now is a good time to sell probably and put them into other markets where you're getting much better value and where you can kind of spread it out a little bit instead of having it all tied up in one or two, overpriced homes or condos.
Yeah, absolutely. I think it's a really good strategy. I think that's why a lot of our investors and a lot of your investors come from markets like San Jose, where they can go to somewhere where it is much more affordable and they don't have some of those problems. I think that makes a big difference.
Okay.
Should we talk about Tampa? I think Tampa is a really good market.
Sure. We can talk about Tampa.
So Tampa is much stronger. It's only 17% above the last bubble. So when we talk about San Jose being 95% above the last peak, Tampa is actually below the national average. The national average is 22% above the last bubble of 2007, and Tampa is only at 17% above. So it's made some recovery and gone up a little bit, had some strong appreciation like you'd expect.
Yep.
But it's actually really good, and its appreciation has been 204% since 1991, compared to a national average of 280. So that means there's still potential room for growth, I think, with Tampa. Over the last 5 years, it has done tremendously well. If you got into Tampa 5 years ago, you've seen 62% appreciation over the last 5 years, and the last year has been 10.6. So you're showing that Tampa still is an extremely strong market that's seeing good appreciation.
It is. And what I like about it, in the last 10 years, I mean, you're saying prices have gone up 17%, which isn't a lot, or maybe some people think it might be a lot, but the population in Tampa has grown tremendously in the last 10 years. A lot of jobs have been created, and the builders certainly aren't building anywhere near enough houses to cater for that population. So I'm surprised that it's not growing anymore. And I think the fact that there are so many people moving here bodes well for anybody that's buying properties, because there's a lot of room for further growth. Tampa is a very, very affordable property in terms of the median home costs, in terms of the affordability, the quality of life. It's a very safe place to invest. I mean, it's a lot of people that want to live here and rent here.
Well, and, you've got a lot of other strong things going for. I'm such a data junkie, as this spreadsheet kind of confirms. But Tampa's median home age is only 37 years. So that's really strong. 54% of your housing stock was built between 1970 and 2009. So what that means is Tampa allows you to get a much newer construction home than most cash flow markets, say, in the Rust Belt.
That's a good point. That is a good point. Okay, so a lot of good stuff in Tampa there. So tell us a little about one of your markets. You want to talk about maybe Huntsville and talk about the stats there and what makes it interesting?
Yeah, absolutely. I'll cover some stuff about Huntsville. That's a good market. That's a good market to talk about. So Huntsville has had a run up from in appreciation. Right now, the 2000 median foreclosure price is only $91,000. So what that means is we're able to buy C plus properties for $40,000 to $50,000 and do $30,000 in renovation, and we can provide a turnkey property for somewhere between $90,000 and $105,000 that rents for about $950 a month. So from an appreciation standpoint, we are about 56% above the last national peak. And that's that. So we actually have done more appreciation. It might be a little bit more of a bubble, maybe even than Tampa in some regards. So we definitely are having to source off-market properties. Our median home cost right now is $196,000, and at the March 2007 peak, it was at $125,000. So Huntsville's seen a huge run up, and that's largely because there's been so much job growth and so much population moving there. They expect it to double in size and be larger than Birmingham. So it should be bigger than 1.2 million within 20 years, and it's only at 500,000 today. So it's a small market, and so that kind of growth is really propelling values quite a bit.
And I think the kind of market segments that you operate in, where you're selling these really nicely renovated houses for $90,000 to $110,000, that's the sweet spot. There's always going to be demand for lower middle class properties, for C plus class properties. There's always going to be rental and resale demand in that area. The properties that are a little bit more expensive or a little bit lower end would be much more difficult to find tenants and buyers for. So I think you're operating in that sweet spot, and the fact that you can sell a renovated property for under $100,000 that rents for $950 a month is great. I mean, there's not a lot of markets where you can do that. And that definitely makes Huntsville and maybe a couple of other markets in Alabama very interesting.
Well, and the property taxes are also so low compared to a lot of the other cash flow markets, because the tax burden on that $95,000 or $100,000 house might be $700 a year. Whereas if I were in Michigan or Ohio or some of those other states, it might be $1,400 or $1,500 a year in some states. And so it gives you, even though the rents might be $100 lower, the property taxes might also be $120 lower per month on your tax burden. So you got to make sure you're comparing apples to apples when you're looking for turnkey, regardless of the state. I think that's a good point.
Okay. So any additional, kind of final thoughts on real estate cycles, Jared, and what people, should be aware of or what they should avoid?
I think it's just important to see how much was the run up between the year, say 2000 and now. How much have we gone above the last bubble, and how does the median income relate to the median home cost? So we have what we call an affordability ratio or an investment success ratio, where we just take the median income and divide the median foreclosure price by the median income. And it basically gives us a barometer that allows us to compare one city against another for a success on cash flow. And the lower the number, the better. So, Huntsville and Tampa both have really strong numbers there, because we're at 1.76 for the investment success ratio. Whereas if I were to look at, say, an expensive market like San Francisco, I might be at 14. So I might be 14 times less likely to cash flow in, say, a Manhattan or something like that than say a Huntsville. So those are important to look at. So Los Angeles is 7 times more expensive. You're 7.5 times less likely to cash flow in Los Angeles than you would in Huntsville, for instance.
Wow. That's something to bear in mind. Well, I'll definitely put a link in the show notes to that. What did you say? It was jaredgarfield.com/report, where people get more information on this kind of stuff.
Yeah, absolutely. That would be great. Thank you.
No, happy to do it. So, kind of, related to that, but slightly different is kind of market segments. And, previously a lot of people have talked about the baby boomers and how they've been changing every market they've gone into as they've moved through the different demographic cycles. And more recently, everybody seems to be talking about millennials and how, for example, they tend to buy property a little bit later. They prefer to live in more urban areas, the certain types of things they want. I mean, what types of properties do baby boomers and millennials want these days? What should investors potentially bear in mind if they decided to target them?
Well, that's a good question. I think to do that, you have to understand the cycle of the consumer cycle. Most people they get married at, say, 23, and this is across all countries in the world. Generally, it may go up or down a year or two in age, but people have a baby at 27, buy their first home at 32, their move up home at 42, and then their peak income years are 46 years old is when they have the most income, and that's when they might buy luxury homes or a beach home. And then when they turn 65, they downsize, maybe buy a second home, go to a condo, go to a patio home, or move closer to their grandchildren. And so what I think you have to look at right now is 2 things. With the baby boomers, I think that you want to avoid the McMansions in the suburbs, because millennials, which is as big of a generation as the baby boomers, they're not buying in the suburbs. They're buying more in town and stuff like that. And Generation X is half the size of the baby boomers. So who's going to buy the glut of the McMansions that the baby boomers are selling off when they realize they don't need that much square footage? They don't want to take care of that big of a yard. So I would avoid those homes, and I would focus for baby boomers on patio homes that have small yards, that are all one-level ranches, maybe that has some luxury, nice granite countertops, because if they're coming from their McMansion, they still want something nice that feels like it has some luxury to it. And so I would be looking at energy efficient patio homes and stuff close to hospitals and to shopping. And the baby boomers are very active. They still want to be close to shopping and entertainment. And for millennials, I think you want to look at starter homes, and you want to focus it on townhomes and condos, and if they cash flow well, or in town, row houses, and small homes, homes that are starter homes in the city.
Okay. It makes a lot of sense. I mean, you should just go with the current. I mean, why try and buy a house that's going to be difficult to sell? And you can just know that a big house, an expensive house, has got a much smaller target market, especially if the people that traditionally lived in them are trading down. And similarly, it's a lot easier to sell starter homes than it is to sell upper middle class homes, for example. And it's a lot easier to rent them too. So that makes total sense to me. And
you have more exit strategies. And I think that's mainly what Torcana focuses on. You guys are selling a lot of, starter homes that are, maybe 1,200 to 1,500, 1,600, 1,700 square feet. Mm-hmm. And for some demographics, that might be the move up home, not the starter home. But there's more exit strategies because they still cash flow. If you want to sell them to an investor, you can do that. If down the road an investor owns it, they want to sell it to an owner occupant that wants to have it be their starter home, they have that as part of their exit strategy.
Yeah, I think about it in terms of a ladder, and there's always people moving up and down the ladder depending on the market cycle. And when the economy is expanding and booming, people are moving up the ladder. They might be trading up from maybe a condo or a multifamily into a nice single family home, or from a nice single family home into a kind of a pool home near a lake with vaulted ceilings or whatever. And then when the market's contracting and there's much more kind of sellers and buyers, you people trading down. They're selling the large pool homes, the newer homes, you're trading back down into the starter homes, you're trading back down into the multifamilies. So I always try and position myself, and I suspect you do, I always try and position myself in the middle of the ladder, which is kind of these 12 to 1,500 square foot starter homes that are below the median prices, that I'm in the $130,000 to $50,000 range, when a lot more homes are, 200 plus. So there's always going to be demand for that kind of lower middle class property that's just below the average cost and below the average rent. There's always going to be demand for it, both from renters and from buyers in any market cycle. So just kind of position yourself in the middle, or better still, slightly below the middle, and you'll find yourself with a house that's, very easy to sell.
Yeah, there's good wisdom in that, Colin. And I'm experiencing something like that right now in a house that I'm looking at buying personally. It's on over 2 acres. It's got a nice pool and about a 2,200 square foot pool house on the land. It's a nice property, but in the main house is about 4,000 square feet. Wow. Beautiful home. But the guy's asking a very large price. It's probably double the median home price for the market that it's in. It's been on the market for over 2 years, and he told me it's been vacant for 5. And so even though I'm interested in it, it's got some maintenance because it's been vacant for 5 years. It's a little bit outdated, which makes it harder for him to market. And this guy owns, 6 law practices in the town, in the surrounding areas there. And so he's done very well. He's a developer. He's developed country clubs in the area. He's done very well, but he's having a hard time selling this house. And he moved down to a nice ocean lot, and so he's been anxious to unload this. But of course, my offer reflected the condition. And of course, it's going to be it's a low ball offer, because I know it's been on the market for 2 years. And I know that the market, if you're buying a house double the median home costs, you've got very limited exit potential, as seen by a home sitting vacant for 5 years.
Yeah, so I think that's a great opportunity if you want to live in a big house with a big piece of land for like a relatively long period of time. You can negotiate a very good price with the seller. That would be, in my view, an extremely poor choice as a flip, for example.
It would. And you know what? It would be a poor choice for me to buy, because I would end up being on the back end, being upside down, except for the terms. Let me tell you the terms that I offered. Okay. I told him that I was willing to go in on a 0% interest loan that he needs to owner finance for 5 years, because that allows me to give him his price. I'll pay his top dollar price where it's been sitting on the market for 2 years. I told him I'd put $40,000 in renovation to modernize the property. But see, the garage apartment, I could rent out for about $1,000 a month very easily. And it's separate enough from the house that I don't mind that. And so the idea was, if I paid him $1,800 a month, and I got $1,000 from the garage apartment, which I would, the apartment for the pool house that I would finish off, because it doesn't have the kitchen in yet or the bathroom. So if I put that in, then what I was going to do is get the rental income from that. And by doing that, I would have that house, as amazing as it will be, at $900 a month. And over 5 years, I'd pay him $108,000 that would go straight towards the principal, because it's a 0 interest loan. And then my loan balance would only be $210,000 by the time I was done with the $150,000 credit that I would have 5 years later. And so that's the only way that I would structure a deal, because that makes it a win for me, so that I don't have to worry about being upside down. So you can get creative. When you find these types of homes, there are opportunities, but you've got to be able to figure out how to get creative, because otherwise you could really end up being upside down.
That was an awesome deal. And that was so clever of you and so creative, that you knew you had this seller who clearly didn't have a mortgage on the home, or if he did, you had no problem holding on to it a bit longer. That was able to, I've never heard of 0 interest seller finance. That's a pretty good deal for 5 years. And you can rent out a unit on the property while you're paying him back the principal. That's an awesome deal, and a great way to go about it if you want to get yourself a tremendous family home at a great price where you're putting very little of your own money down for it, and what you are spending is making your own home better.
Yeah, absolutely. And I hope that your listeners will think of that as they think about buying their own homes. You got to be very careful, because when we buy our own homes, we don't usually think from an investment standpoint. But I think it's important to think of it from an investment standpoint, because you don't want to be upside down on your personal home if you bought at the wrong time of the market cycle, or if you bought a huge home that's above the median home cost quite a bit, and there aren't as many buyers on that, because millennials aren't going to be buying those types of homes for a very long time.
Yep. No, I agree. And I thought about it. I bought a home a year ago, and, I'm obviously Irish, and I'm used to living in cities where people live in relatively small homes. So I bought a 2,000 square foot home, which for me was a huge home. But in the neighborhood I am, it's small. It's the downsizing home for the neighborhood I'm in, despite it having, 3 bedrooms and 2 bathrooms and a 2-car garage and an office and nice patio and everything else. It's a huge home for me and my kids and my wife. But in the neighborhood, it's the downsizing home. Most of the homes around me are, 500 to 2,000 square feet bigger. So what that means is that if I ever wanted to sell this home and move into something bigger, I could do it a lot quicker than the average property here. There's a lot more demand for this floor plan than the big floor plans, particularly among people that are downsizing. So I absolutely had that in mind when I was buying the home. Number one, because I didn't need a huge home, because I never really lived in one, and 2,000 square foot was more than enough. And number two, I knew that if I ever wanted to sell it, I could find it a buyer, very quickly.
I think that's a really good point. And I think that we consume so much, keeping up with the Joneses and being all flash and no cash doesn't make any sense. We want to buy assets that will put money in our pocket. And that's exactly what people can do with you or me in Alabama or in Tampa, is get some really good assets that'll put cash flow in your pocket and let the tenants buy them for you.
Yeah, amen to that. Well, look, a lot of wisdom there, Jared. I really appreciate your insights and your time. And I know you have your own podcast as well. So if people want to learn a little bit more about you, your business, your podcast, what's the best way for them to find it?
Well, we're on iTunes, and we're also on Google Play. So you can find us on most of the major iTunes services. Mm-hmm. And if you want to go directly to the link, I'll tell you what that is. Just one second. All right. So the link is roiwealthwatch.libsyn, LIBSYN.com. Okay. And that's a good place to be able to listen to it. We have quite a few episodes on topics like this. And we did a great episode a couple of weeks ago with Colin. So come listen to what Colin had to say on our podcast. And I really enjoyed being with you today, Colin. Thanks for taking the time.
No problem at all. And I'll make sure I get all those links on our show notes, Jared, so that people can click on them directly from their phones or whatever device they use. So thanks again for your time. And hope to see you again soon.
Sounds good. Great visiting with you. Bye-bye.
This recording contained general information relating to the real estate market, and it is for educational purposes only. Buyers should always seek appropriate legal, tax, and financial advice from suitably qualified professionals before entering into any real estate transaction. Actual returns from rental properties will always vary from person to person and deal to deal based on unique circumstances. And while we've no reason to doubt the validity of comments of any guests on our show, we do not warrant their accuracy. Thank you.
Thank you for listening to the Real Estate Investment Podcast with Colin Murphy. Don't forget to hit subscribe on iTunes, Stitcher, and Google Play for new episodes and tips on building a rental property portfolio.